Hello everyone. I am Shubhra Bhatia, Assistant Professor, Department of Commerce, BSSS College. The topic of my presentation is the concepts, functions and principles of insurance. Before understanding the basic concepts of insurance, let us first understand the basic concept of risk. So what is risk? Risk is the uncertainties which we face in our everyday life. So we can say that life is full of uncertainties. The life and property of an individual are surrounded by the risks of death, destruction, and disability. These risks may result in financial losses. Majorly, there are 4 ways of handling any kinds of risks. These 4 ways are: first is avoidance, second is retention, third loss prevention and reduction, and fourth is sharing and transferring. Insurance is one of the best examples of sharing our risk to the other party. Now, why would this other party bear our risk? This other party would bear our risk in exchange of a consideration. What is this consideration? This consideration is called premium in terms of insurance. Risk is an inherent part of our life. Insurance is a prudent way to transfer all kinds of risks to the insurance company. It offers protection against unforeseen risk, just like a raincoat or an umbrella provides protection to us against the rain. So, now let us take a look at the concepts of insurance and the basic functions and principles on which an insurance industry works. So, what is insurance? Insurance is a legal agreement between 2 parties. Insurance company on one hand, who is giving the insurance, and insured, that is the person who is taking the insurance. Insurance company is ready to make good the loss of the insured in case of any contingency. Now, what is a contingency? The contingency is an event which causes a loss. And it is called a contingency because there is an uncertainty regarding the happening of that event. This service of protection is given by the insurance company to the insured in exchange of a consideration, and this consideration is called premium. This premium can be paid either monthly or quarterly, biannually or annually. So after understanding what is insurance, let us now look at the basic features or characteristics of insurance. The very first characteristic of insurance, as was mentioned in the definition as well, was the essentials of a valid contract. Every insurance contract should have all the essentials of a valid contract, which are: there has to be at least 2 parties in the contract, there has to be a lawful objective, there has to be offer and acceptance. Now, there's something to be understood in this offer and acceptance. The offer of the contract of insurance is made by the insured, that is the proposer who is planning to take the insurance policy, and acceptance is given by the insurance company. So, the offer is made by the insured and it is accepted or rejected by the insurance company. The fourth essential of a valid contract is free consent. That means there is no compulsion on any individual to take insurance or not. And the last essential of a valid contract is lawful consideration, which is called premium in insurance. The second characteristic of insurance contract is sharing of risk. Insurance is a device to share the financial losses which might befall on an individual or his family on the happening of a specified event. The event may be the death of the breadwinner in case of life insurance. Third important characteristic of a life insurance or of any kind of insurance is it is a cooperative device. This is the most important feature of every insurance plan. It is only because of the cooperation of a large number of people who agree to share the financial loss arising due to a particular risk that is insured. Such a group of persons may be brought together voluntarily or through publicity. An insurer may not be able to compensate all the losses from his own pocket. So, by insuring or underwriting a large number of persons, he is able to pay the amount of loss to each and everyone who is suffering the loss. Like all cooperative devices, there is no compulsion here on anybody to purchase an insurance policy. It is totally on the discretion of the proposer or the insured to take or not to take the policy. The third important feature of an insurance is value of risk. Now, what does this mean? This means that the risk is valuated before any policy is given. The insurer evaluates the risk involved in that policy. Now, why does it evaluate the risk beforehand? It evaluates the risk in advance so that he knows how much amount has to be charged as premium from the insured. The probability of loss is calculated at the time of insurance. This work is done by underwriters in an insurance company. The fourth important characteristic of insurance is payment at the time of contingency. What does this point say? This point says that the payment is made to the insured at the time of the loss. This means that if the insured suffers any kind of loss, only then the sum assured will be paid to him. Now, there is an exception to this rule. The exception is of life insurance. Since the life insurance contract is a contract of certainty, and because the contingency, that is the death or the expiry of the term of insurance, will certainly occur, the payment is certain to be made by the insurance company. So, whichever happens first, either the death of the insured or the expiry of the term of insurance, the insurance company is bound to pay the sum assured to the insured. In other forms of insurance like fire or marine insurance contracts, the contingency is either fire peril or a marine peril, which may or may not occur. So if that peril doesn't occur, nothing would be paid to the insured. In some kinds of contracts of life insurance, which are called term insurance, payment is made only at the time of the death, and that too if that death occurs during the term of insurance. So that means if the person insured doesn't die within the term of insurance, nothing would be paid to the nominees or nothing would be paid to anybody in this insurance policy. The next characteristic of insurance is payment of unforeseen losses. This means that the loss has to be accidental. It cannot be planned, and if it is planned, nothing would be paid under the insurance policy. It has to be unforeseen, it has to be unexpected at all. Insurance companies do not cover intentional losses. The next feature of insurance is the amount of payment. The amount of payment depends upon the value of loss that occurred due to the particular insured risk, provided insurance is there up to that amount. This means that the amount of loss or the amount of sum assured, whichever is less, will be paid to the insured in case he suffers the loss. In this case also, life insurance is an exception. So whatever sum assured is there in case of life insurance, it will be paid in whole to the nominees or to the family of the insured. The last important characteristic of insurance is a large number of insured persons. That means pooling of large risks. To spread the loss immediately, smoothly and cheaply, a large number of persons should be insured. The cooperation of small number of persons may also be insurance, but it will be limited to a smaller area. The cost of insurance to each member may go higher if there are less number of people. So it may be unmarketable. Therefore, to make the insurance cheaper, it is essential to insure a large number of persons or property, because the lesser would be the cost of insurance and so the lower would be the premium. Now let us understand this with the help of an example. Suppose there are 100 persons who are all aged 50 and are healthy. It is expected that of these 50 people, 10 persons may probably die during the year. If the economic value of the loss suffered by the family of each dying person is taken to be rupees 10,000, the total loss would work out to rupees 1 lakh. So, if each person of the group contributes rupees 100 a year, the common fund would be rupees 1 lakh. This would be enough to pay rupees 10,000 to the family of each of those 10 persons who may die. Thus, 100 persons share the risk of loss due to death suffered by 10 persons. From this example, it can be seen that the insurance is a very useful financial tool for pooling, sharing, and transferring of the risk so that the financial loss caused to one person who suffers due to a peril is compensated. So this can be the situation of the persons who don't take insurance. And this can be the situation of the people who prefer taking insurance and their losses are compensated. After understanding the basic features and characteristics of insurance, let us quickly understand the functions of insurance which are derived from the features of insurance only. The functions of insurance can be classified into primary functions, secondary functions, and other functions. The basic primary functions of insurance are: it provides protection, it is collective bearing of risk, and it provides certainty. Insurance eliminates the uncertainty of an unexpected and sudden financial loss. This is one of the biggest worries of a business. Instead of this uncertainty, it provides the certainty of regular payments, that is, the premium to be paid. Here, it is important to understand that insurance does not reduce the risk of loss or damage that a company may suffer, but it provides a protection against such loss that a company may suffer. So at least the organization or the person who is taking the insurance policy does not suffer financial losses that hamper their daily functioning. After primary functions, the major secondary functions of insurance are: it provides prevention of losses. Now, how does it provide for prevention of losses? The person who is taking the fire insurance policy is compulsorily required to safeguard its property against the fire perils. It can be done through fire extinguishers. It can be done through other measures. The secondary function of insurance is small capital to cover large risk. Only small amount of premium is required to be paid by the insured to cover the larger risk, to cover the risk of large amount. The third secondary function is contribution towards the economic development of industries. Now, how does insurance provide for development of industries? The premiums collected by insurance companies are invested in different sectors, are invested in different industries, thereby leading to the overall development of the industries. The pooled premiums of the policyholders help create a capital for the insurance company. This capital can be then again invested in the productive purposes that generates income for the company. The other functions of insurance may be that it is a means of earning foreign exchange, it is a source of savings and investments, and it is an altogether a risk-free trade. Now, before starting with the principles of insurance, let us first understand and recall that how does insurance work. The insurer and the insured gets into a legal contract for the insurance, which is called the insurance policy. The insurance policy has all the details about the conditions and circumstances under which the insurance company will pay out the insurance amount to either the insured person or to his nominees. Insurance is a way of protecting yourself and your family from a financial loss. Generally, the premium for a big insurance cover is much lesser in terms of money paid. The insurance company takes this risk of providing high cover for a small premium because a very few insured people actually end up claiming the insurance. This is why you get insurance for a big amount at a very low price. Any individual or a company can seek insurance from an insurance company, but the decision to give or not to give the insurance policy or the insurance cover is at the discretion of the insurance company. The insurance company will evaluate the claim application to make a decision. Generally, insurance companies refuse to provide insurance to high-risk applicants. As we discussed earlier, insurance is actually a form of contract. Hence, there are some principles that are important to ensure the validity of the contract. And both the parties, that is the insured and the insurer, are compulsorily required to abide by all these principles. So the first principle of insurance is the principle of insurable interest. A person can enter into a valid contract of insurance only if he has an insurable interest in the object or the subject matter for which he is seeking insurance. A person is said to have an insurable interest in the property if he is financially benefited by its existence and is suffering a loss by its non-existence. This means that the insurer must have some pecuniary interest, some monetary interest in the subject matter of insurance. This means that the insurer need not necessarily be the owner of the insured property, but he must have some vested financial interest in it. If the property is damaged, the insurer must suffer from some financial losses. So, the relationship of the person taking insurance with the subject matter should be recognized in law and should give him a legal right to insure that property or to insure that person. Insurable interest is the monetary interest in the subject matter. In case of life insurance, a person is assumed to have unlimited interest in his own life. He is assumed to have insurable interest in the life of his spouse. A father is assumed to have insurable interest in the life of his son or his daughter, and a son or a daughter is assumed to have insurable interest in the life of his parents. In case of fire insurance, the owner of the property is said to have an unlimited interest in his own property. The partners in the property of the firm are said to have insurable interest in the property of the firm. In case of marine insurance, the owner of the ship is said to have unlimited interest in the ship. Similarly, the ship owner is assumed to have insurable interest in the freight which he has to receive. The second major principle of insurance is principle of utmost good faith. All the insurance contracts are the contracts of utmost good faith. Disclosure of all material facts is compulsory in an insurance contract, and any fraud or misrepresentation of facts can result into cancellation of the contract. Something very important to understand here is that what is a material fact? So, any fact or circumstance which influences the mind of a prudent insurer in fixing the premium or in determining whether to give insurance or to reject the proposal of insurance is a material fact. If it is later discovered by the insurance company that some facts were hidden by the insured, the insurer has full right to avoid the contract and deny the payment at the time of loss. Disclosure of all material information has to be made by both the parties to the contract. Hence, the contracts of insurance are referred to as the contracts of utmost good faith. Some of the examples of material facts are: in case of life insurance, the name, the address, the occupation, the date of birth, the health condition of the insured are considered to be the material facts. In case of fire insurance, the construction and description of the property, the situation of the building. The third principle is principle of indemnity. The purpose of insurance is to compensate the loss. It can never be used to make profits. Insurance, like fire and marine insurance, are contracts of indemnity. Here, the insurer undertakes the responsibility of compensating the insured against any possible damage or loss that he may or may not suffer. Life insurance is not a contract of indemnity. Now, what does this indemnity mean? Indemnity means that the insured will be compensated only up to the extent of the loss. The next principle of insurance is principle of subrogation. This principle is called doctrine of rights subrogation, which means that the insurer steps into the shoes of the insured after settling the claims or after paying compensation to the insured. After indemnity, the rights of the insured to claim any damages from any third party gets subrogated to the insurer, And this taking over of rights of the insured by the insurer is called subrogation. In simple words, once the compensation has been paid by the insurer to the insured, the rights of ownership of the property will shift from the insured to the insurer. So the insured will not be able to make any profit from the damaged property or sell it. Now let's take an example. An individual buys a motor car and takes an insurance for the car. Now this car is damaged by the careless driving of a truck driver. Now individual who has taken the insurance policy claims damage from the insurance company. After taking compensation from the insurance company, the rights of the insured to recover damages from that truck driver are transferred to the insurance company. He cannot recover any more damages from the truck driver. The next principle of insurance is principle of contribution. Sometimes what happens, a person takes an insurance policy from more than one insurer. So if he gets that subject matter insured from more than one insurer, then at the time of loss, all these insurers will have to bear the loss in the same proportion in which the insurance policies have been taken from them. This taking of insurance from more than one insurer is called double insurance. If the insured claims full insurance coverage from one insurer, he loses his rights to claim any amount from other insurers. In such a case, the insurer who has compensated the full amount to the insured has the right to recover the part of insurance coverage from other insurers. Now, one example for this could be, suppose if a property is insured under 2 fire policies, each for rupees 2 lakhs. In the event of partial loss of rupees 1 lakh, the insured is entitled to recover the full loss from any one of the insurers. The insurer who has compensated the full amount of rupees 1 lakh to the insured has the entitlement to recover from the other insurer his proportionate share of rupees 50,000. So, the different insurers under different policies contribute in indemnifying and paying for the loss caused by the insured peril. The sixth principle of insurance is the principle of proximate cause. The term proximate cause is a Latin word which means nearest or the immediate cause. In case the loss occurs due to more than one reasons, more than one causes, then according to this principle, the nearest or the direct cause of the loss is to be considered while compensating to the insured. The nearest cause of the loss is considered as the actual cause of the loss and not the remote cause. If the proximate cause of the loss is covered under the policy conditions, only in that case the insurance cover will be paid to the insured. Otherwise, he will be denied for any loss coverage. Let's take an example. An insured suffered injuries in an accident and was admitted to the hospital. While undergoing treatment in the hospital, he contracted some infectious disease which caused his death. Now, in this case, the court held that the proximate cause of death was the disease and original cause of the death was merely a remote cause. As such, the claim is not payable under the personal accident insurance. Now, let's come to the last principle of insurance, which is mitigation of loss. Mitigation of loss means to minimize or decrease the severity of loss. Whenever the loss occurs, it is the duty of the insured to take all the necessary and reasonable steps to minimize the loss as would have been taken by any person who is not insured. As such, it is the duty of the insured to act to minimize the loss. If the person doesn't act in a prudent manner, he won't be compensated under the policy. I hope by now the concepts, functions, and principles of insurance would have been clear to you. We will meet soon again with a new module. Thank you.